I always say getting in is easy, getting out is hard. So by using asset allocation's discipline and just leveraging the reallocation process, you take the emotion out.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and I have a belief that everybody out there needs a financial plan in life. If you fail to plan, you plan to fail. So let's get into it. I'm joined by my producer, Allie, today. Allie, welcome to Ask the Planman. What I want to talk with you about today is your checklist for 2024, or no matter when you're listening to this, your New Year's resolutions when it comes to your financial game plan. And I want to give everybody some tips of to-dos, whether it's October, November, December, at the end of the fourth quarter, or as you enter into January of the new year. These are things everybody should be doing no matter what's going on in their world. I know you're wrapping presents and unwrapping presents and lighting candles and doing all kinds of Kwanzaa things, but you got to take care of your finances. So, Allie, let's get into what people need to do first and foremost. I think the biggest thing to start out is most people have investment portfolios. At the end of the year, all of those metrics are now printed and published for your reviews and considerations. Well, what do I mean? I mean your performance reports. How did that mutual fund do? How did that stock do? Did you have a loss? Did you have a gain? What was your total performance? So all these indexes come out and they report their performance. Now, the biggest mistake people make is they look at last year's performance and then they say, oh, I better put some money into that vehicle. And that's chasing performance. But I'm an asset allocation purist over the years. And what I've educated clients is you don't want to chase performance. You actually want to shy away from the higher performers. Now, I'm not saying get out of a high performer, but I'm talking about pruning. The key behind asset allocation is trimming profits and buying into the underperforming asset classes for the new year. And there are these quilt grids that are out there. You could Google them anywhere. Just put financial investment quilt grids, and you'll see 10, 20, 30-year performance grids of all the different asset classes. Let's break it down a little bit deeper. Asset class, large cap stocks, large cap value, large cap growth, two different asset classes. Small cap growth, small cap value, two more asset classes. Mid cap value, mid-cap growth. And you have international, you have emerging markets, you have cash, you have bonds, different types of bonds, municipal bonds, corporate bonds, high-yield bonds, REITs, gold, if you want to have Bitcoin. These are all different asset classes. So if you've got a portfolio made up of all these different components, you've got a pie, and you have slices in your pie. Some slices are larger than others by design. But what happens is the overperformers, their slice of the pie gets larger and larger and starts to overtake the other components. And what asset allocation purists do, the basic rule of investing, Allie, is buy low and sell high. And so asset allocation is a discipline to sell high and buy low. Systematically, unemotionally, you're going to prune your profits. Prune, not cash out. Prune. So if you had something that had 20% of your money and now it grew to 25%, you want to prune it back to 20. If you had something that had 20% and it shrunk to 15, that means it underperformed. You want to add back that 5%. That's buying low. So the first thing you want to do in the new year is assess your performance and hit the rebalance or reallocation buttons in your portfolios. If you're working with an advisor, have them rebalance. If you have automated platforms, some of them out there, they may do it for you automatically. At a minimum, I've always encouraged clients to rebalance twice a year, January and July. Some people can do it quarterly. Again, we're not trying to be overly anal about it, but at least once a year, you want to rebalance that portfolio. Now, why? We'll go back to those grids. If you look at that quilt grid and you follow the history of the patterns, year over year, that color pattern at the top, let's just say it's the red box, the red box in that asset class are not the top performer year after year after year. You'll see they start to slide down. They'll hit the bottom. They'll start to come their way back up. And the guys at the bottom all of a sudden start gravitating to the top, eventually hit the top, and then roll back down. And so all these asset classes go through cycles throughout history. In simple numbers, folks, if half your money is in stocks and half your money is in bonds, and interest rates go up, as they did in 2023, your bond prices went down and your stock prices have gone up. We're at all-time highs on the stock market. So your stocks have done really well and your bonds have done pretty poorly because of a rise in interest rates. Well, if you own bonds coming into the year, you had very low investment rates on your bonds, and now you have an opportunity to put more money in bonds at a higher rate. If you bought a one-year CD at 1% and now you can get a one-year CD at 5%, wouldn't you want to be able to have money to move over and buy 5%? Yeah, well, where's it come from? It's got to come from somewhere else. So you're going to sell some of your stock winnings and you're going to move it over to your bonds, and you're going to be able to buy new bonds in the new year at a higher interest rate. And so it's this swashbuckling back and forth over time, multiplied by 5, 10, 20 different asset classes. And that's how you dampen risk. And that's how you don't let your portfolio run away and take unmitigated risk. You can't just have all your money constantly in the same vehicles year after year after year after year and never take some of those profits. I always say getting in is easy, getting out is hard. So by using asset allocations discipline and just leveraging the reallocation process, you take the emotion out. Does that make sense?
Yeah. It actually brings up a question for me here. When you're talking about kind of asset allocation and where, the breakdown of it, what would somebody's portfolio look like in their 30s versus their 50s? High level, I know you can't give too many specifics here, but high level, how would you structure each?
Well, so the asset allocation, if you go back to the financial planning journey, and we're going to talk about this in another episode of the 3 things you can control in your financial journey. And that is going to be the rate of return you try and achieve on your money, the amount of money you save and spend, and the time frame for reaching your goals. Those are 3 things you can have some control over. And we're going to do a deeper dive on that in our X Factor conversation episode. And so when you do the plan's going to back into and test for you different rates of return that are needed to achieve success. And so I always use the analogy over the years of think about when you get in your car and you have a trip to make, you have a certain expectation of how fast you're going to drive to get there in time. And so 60 miles an hour, 65 miles an hour might be your average speed that's required to get from point A to point B. So I'm down here in South Florida and I want to drive up to Gatlinburg, Tennessee for a vacation, and it's normally a 14-hour drive. Well, that's based upon a certain amount of assumptions, right? It's a rate of speed, and then, I got to stop and walk the dogs, and I got to use the restroom, and I need gas, and we're going to get a snack, and we're going to stretch our legs. So you start to factor in these other little roadblocks, along the way. And so if I still want to get there in 14 hours, and I just lost 20 minutes at the rest stop walking the dogs, well, now can I keep going 60 miles an hour, or do I need to go 75? So something's going to change. Either I need to change the rate of speed, or I need to change the time of when I'm going to arrive. And if I wanted to arrive at 10 p.m., now all of a sudden I'm going to arrive at midnight. Well, I don't want to drive at night. I don't want to be arriving at midnight. I need to go faster. Now, by going faster, I run the risk of what? Getting a speeding ticket, getting pulled over, which now slows me down even more. So now take that analogy and put it into your portfolio. As you're saying, your portfolio design is, if I want to turn $5,000 into $5 million in 3 years, well, that seems awfully daunting and near impossible. Like, what kind of rate of return is that? And is it really possible to do something like that? Now, again, I'm just making up those numbers, but I'm sure somewhere, somehow, if you got lucky enough and took a ton of risk, you might be able to convey $5,000 to $5 million, but like you'd probably be at the roulette table, like to get that kind of return. Like you're just not, but one bad spin, you're going to get wiped out. So it comes down to risk. So in an asset allocation model, the basic premises, and again, I'm not saying I'm a fan of this, but one of the rules has been take your age, subtract your age from the number 100. And that's how much money you should have in stocks. And then your age might be what you have in fixed income or bonds. But most 30-year-olds don't want 30% of the money in bonds, especially when it was paying 1% the last 10 years. Now maybe at 6 or 7%, maybe. Maybe you could start to justify that. But when somebody goes from their 40s to their 50s to their 60s, that rule of thumb is 40% in bonds, 50% in bonds, 60% in bonds, 70% in bonds, 80% in bonds. So that as you're getting older, it's less and less equity or stock exposure because of the potential loomings, as happened in my 38 plus years of doing this, is we have stock market corrections. And so one of the biggest ways to protect your stock market downturns are to have less and less money in stocks as time goes by. But historically, if you've got 20, 30, 40, 50 years to invest, just like real estate or anything else, they run through cycles, and the next upcycle will usually, historically, has always made newer highs, which is where we are today, right? We're at all-time highs. But in 1987, when the stock market crashed and I was a brand new stockbroker and we lost 20% in a day, and the dot-com bubble busting in 2001 and losing 30, 40%, in a short amount of time, or the housing crisis in 07 and 08, losing 40%, like that hurts. A 30-year-old, it's going to hurt, but it's going to hurt a 60-year-old even more. Somebody's getting ready to retire and they just lost 40% of their portfolio. That's pretty painful. So it's the devil, and unfortunately, the devil's going to get you to the dance. The dance is going to, the game is to be in the equities to make the double-digit returns, but then you have to mitigate your risk. And one of the biggest ways is just not let your money constantly ride on the same horse, right? You can't have look, you could have made a ton of money like Elon or Buffett or Gates. They made their billions riding their company. That's a lot different than the average person out there. And it doesn't mean all your money should be in Tesla or all your money should be in Apple or, these other names. But if you backed them over the years and did very well financially, have you been pruning or have you been adding more and chasing into the performance? And yes, it's been rewarding because it's been hitting high after high after high. And you're buying high and hoping it goes higher versus buying low. The Warren Buffett way is you buy low, you buy value. So there's value investing and there's growth investing. And again, it's just different ideologies. People need to educate themselves, talk with their advisors, or just get help in understanding what all these terminologies mean, which is why we're doing the show, is to get into, more and more of that education for people. So I'm not telling you what to do. I'm telling you how it works. And so you have to go about it. So, a younger person, 20, 30, 40 plus years of age, you can certainly make a case for equity being very heavily influenced in their portfolio and very little fixed income. But the fixed income used to be the safe harbor in the storm. Another term I use, or you may have heard, is bonds are defensive. They're not necessarily safe. And I say that because look what happened with bonds in the last 2 years as interest rates finally reinflated. If you're sitting in a 10 or 20-year bond that's paying 1 or 2%, look at mortgage rates. They've gone from 3% to 8% and now settled back down in the 7s, maybe even the 6s. But that's a behavior off of the Treasury bonds and the Fed raising rates and that knee-jerk reaction. So if somebody had a bond at 3% and now that interest rate environment goes to 8%, what's the value of the bond that they just bought for 3%? It got destroyed because it's going to be priced to the market because the new investor is expecting 8% and that bond's coupon is 3%. And the person who bought it at 3% is stuck with it till it matures, but they're probably losing 80 cents on a dollar They're getting clobbered. Their portfolio is going to show a massive loss, which is why you've seen systemic risk coming with certain banks. Silicon Valley Bank, these other banks had massive bond positions that in 2023, they went out of business. Their balance sheets got destroyed because their bond portfolio got hammered. You would think they're professionals, they would know better about a rising interest rate market and how to hedge their bond portfolios, and they didn't. They got slaughtered. So now could be a good time. If interest rates go down and you're locked into the 7% fixed income product, right? A bond paying 7 and rates go to 5, you got a 30-40% increase in your bond value. But at the same time, you got to give up your 7% interest rate. So some people won't take the profit. They just want the income. And so there's this age-old, 100 plus years of back and forth of how and what to do with things. So bonds are great. Individual bonds certainly are the safest because there's maturity dates. You know exactly when your money's coming in. Bond funds can be dangerous because you don't know the mix of the portfolio. You don't know when the money's going to be maturing. You don't know what the bond manager's doing, holding or dumping and taking losses. So, if you have enough money, individual bonds are usually a safer play than a bond fund. But most people just use bond funds by default. It's got built-in diversification. It's managed by somebody else, but it comes with a different risk. And people have to understand risk, but people don't understand risk until it goes against them. And they're like, oh, I didn't know that could happen. Well, yeah, that's what we're talking about. Like why you could all of a sudden have a 30% loss in your portfolio. What was the risk factor? Well, rising interest rates all of a sudden killed your bond portfolio. Did you understand that risk? No, you probably didn't. Does that make sense so far?
Yeah, no, it makes total sense.
So to answer your question, as far as the asset allocation and the aged based, again, I think if you lead with the horse versus the cart, the horse is going to say, well, what rate of return, what speed do I need to drive to get to my destination with the least amount of risk? So there are people out there that will always drive with cruise control, and there are people that'll just go along with traffic. And if the traffic's drifting at 85 miles an hour and they look down and they're doing 85 miles an hour with the traffic and the cop catches them, he don't care that you were just going with traffic. He got you. And cops have said that to me plenty of times. I'm like, I'm just going with traffic. There's cars passing me going faster. Yeah, but I got you. I'm like, thanks a lot. So again, do you want that risk? So if you know the speed limit is 65 miles an hour and you're comfortable going 68 or 70, you put your cruise control there, you probably will never get bothered or have a problem, right? Conversely, if your portfolio is set way too aggressively and the economic conditions change, or more importantly, an event occurs that nobody anticipated, well, now how's the market going to react? Ergo 9/11. Right? 9/11 happened. Market dropped 500 points. Market closed for a week. Market took a beating for months on end. It totally changed the economic situation, and it caused a lot of damage to people's portfolios for that period of time. And then how you behaved, the decision you made, the emotions you had to overcome. Well, the asset allocation purist is doing what? Buying low. We're not selling here. We're buying more. Do you have cash? Yeah, let's move some money from our cash. Oh, you had a gold position. Your gold just went up because of what happened. Let's take some of your gold and oil profits and move it over to equities. That's why you diversify. So the diversification, the asset allocation diversification, is to have asset classes that don't all move at the same time. That's the key component. So when people talk about Bitcoin and cryptocurrencies and they say it's not correlated to the stock market, well, that's proven to be pretty false because it has definitely moved up and down in correlation to the economics and the movements of the stock market. So it does have a positive correlation. It's not a negative correlation, which means it's not a hedge if that's how it behaves. So what asset class is a hedge to your equities? Which is why you have international positions as well as domestic, because sometimes the international markets behave differently. Maybe Japan's in a hot market and Brazil is cold. Maybe I need to be buying more Brazil and prune back my Japanese exposure, right? And again, I'm making all this stuff up, but you understand is the more diversified you are, the more opportunities you have to pluck money in one bad environment and take advantage of the downturn by having capital to free up. Most people should not have tons and tons of cash in their portfolio. You want to have cash as a cash reserve, right? The rule of thumb, 3 to 6 months of expenses put aside in a cash reserve. But at the same time, if the market crashed and you had 6 months of expenses, you might say, you know what? I want to deploy some of that cash and put it in my IRA, 401k, just my regular investment. Like, I want to take advantage of this opportunity, which is why having cash, people hear the term dry powder. All right, so we're ripping down this road here. We're trying to talk about New Year's resolutions and the to-dos. So we're doing a pretty big deep dive on rebalancing and asset allocation here. You have any other questions?
Yeah, the only other question I really have today is to just circle it all the way back over to Weinstein Wealth of how can you help them protect their assets, protect their future, and protect themselves in the new year? And what should they be considering maybe starting in 2024?
Well, we want to talk about their insurance reviews as well, but thank you for that. So look, I don't manage people's money like I used to. We can do some work in the annuity space, obviously the life insurance realm, but a big piece of what we do is we'll collaborate with investment advisors, licensed investment representatives. We're just licensed in insurance these days, so we're not licensed for investment. So I really can't give somebody specific advice, but we partner with others out there, or we'll talk to your advisors if need be, and just kind of give you our 2 cents or opinions. It's just opinions, and that's an unpaid activity. So there's no cost or no obligation. But if you're going to work with a professional manager money, you'll talk to them about what their costs and fees might be. But we're certainly open to any conversation. They could always reach us through our toll-free numbers and stuff, which we'll post in the show notes. The part 2 to the New Year's resolutions is reviewing your insurances. And just like you want to change your batteries in your smoke detectors, I think the rule is every Thanksgiving or something, right? You want to change your smoke detectors. Is that what they say? So, at the end of the year, we go through some cycles. We have open enrollment for Medicare that rolls into open enrollment for health insurance. So it's built in automatically in the fourth quarter for people to review their health insurances, whether it's Medicare, their group plans, their private coverages, their Obamacare plans. And there's that window to review and assess. Now, why is that important? Well, your doctors fall in and out of networks. You might have to change your network because your doctor doesn't take that particular carrier, or your doctor retired. You need to find a new primary. You might need a new whatever. So that's important, as well as your prescription medications. Big part of the Medicare review cycle is changes to the formularies on their prescriptions. Is my prescription drug plan the best plan for the next year based upon these medications and the prices? So you want to understand the health insurance side of the review. Rates go up, the deductibles go up, the group health plans have changes. The bar is always going higher as far as the deductibles, the max out of pockets, the co-insurances. So part of it is just you owe yourself the review to understand what the next year entails. Whether you go to ER or you go to urgent care, what's that going to cost me? If I see my primary doctor, what's it going to cost me? If I have a new prescription, is it generic or is it branded? Well, if it's not generic, it could cost you thousands of dollars unbeknownst. You better talk to your doctor. Is there a version available to me that's generic, which, by the way, might be $3? Big difference. A lot of people are taking very expensive drugs for weight loss now. This, whether it's Ozempic or metformin, or this other one starts with a J. These are diabetes drugs. Guess what? It's recreational use. It's not actually for diabetes. The insurance companies don't want to cover it because you're doing it for weight loss. And those suckers might cost $500 a pop. This is stuff you need to know, right? Or just pay it. Your life insurance, reviewing your life insurance coverage, again, depending on where you're getting your life insurance from, whether it's your own, if it's company provided. We've talked in the past about company benefits and understanding that, your life insurance is at risk to your job and that you should always have some private controllable life insurance on your own in case you ever lost your job or the company downsized or eliminated those benefits. So you want to make sure, based upon your fiscal picture, your mortgage balance, your debt load ratios, maybe you had a new child that came in the year. Now, what do I need to do for that? You might need to pick up another 100 or 200,000 of life insurance based upon those needs or expenses. If I'm self-employed and my income went up, I've got to look at my disability insurance to make sure that I can bump that up and increase my disability coverage for the rate of salary increase that I took. So if somebody has a new business and they were making 50 grand and now business is doing well and they're making 150 and their disability is still pegged at 50, well, there's a big gap there. They better get that gap figured out. They want to get another policy to get that covered up to 150 and whatever the ratios are, right? So there's all these different components. And then why is this so important? Because the reality is, folks, no matter what insurance vehicle you're talking about, it's never going to be less expensive than it is today. It's all and always age-based. And your health, in theory, is never going to be better than it is today. So your insurability will change usually to the negative as you get older, which now makes the challenge of getting life insurance and these other insurances we're talking about, long-term care, disability, even your health insurance. In some regards, your pricing will be determined on smoker and non-smoker status. The beauty of Obamacare is all are welcome. It's guaranteed issue. There are smoker prices versus non-smoker prices, but other than that, there's nothing really predetermining. You're not going to be surcharged because of poor health. That is one of the benefits of the Obamacare platform. But your life insurance certainly is. That's private pay. So if you've got health issues, if you're overweight, you got hypertension, you've got high blood pressure and you're not medicated, you got diabetes and you're not controlling it, you've got other function and problems, insurance companies don't want you. They don't want the risk. They're going to say, you know what, we're going to decline you for now. You need to go see your doctor and get your diabetes under control. Because people drop dead from diabetes. It's a deadly disease if it's not controlled and regulated, right? And even long term, it's not, type 1's worse than type 2, but you get the point. So folks, you want to make sure that you review your coverages. The last piece we'll say is your auto and homeowners. As you're coming into the year, what's changed? A lot of, you see all the TV ads, the Christmas holiday season, people are buying new cars. Well, that new car replacing your old car. There's a new value. There's a higher value. The replacement value is more. My car's worth $30,000 and I go buy a new $80,000 car. Well, what do you think my premiums are going to do? I'm insuring an $80,000 car now, not a $30,000 car. My premiums are going to go up. Right? So if my coverage is in alignment, did the rate changes, what regulatory changes came about? We always caution people, don't buy state minimum, based on price. You want to make sure you have your assets properly covered. A state minimum auto policy might be $25,000 of liability, and somebody who has money gets in a terrible accident, is at fault. Well, the most the insurance company is going to pay is 25 grand. And now you've got $1 million settlement against you. That's coming out of your wallet, man. That's coming out of your pocketbook. So penny wise and dollar foolish. Same with your homeowners. Again, back to the smoke detectors. You want to make sure that your house is properly protected. Down here in South Florida, it's hurricane, season rolling over. It just ended. Are you prepared for the next one? Do you have the proper coverages? What if a hurricane comes in? Do you have the proper wind and flood coverage? Yada, yada. You're living outside of those markets. Again, how much did my house appreciate? We've had a great boom with COVID. Home prices have gone up, depending on where you live, 30 to 50%, maybe even 100%. It's the same conversation. If my house was insured at $300,000 and now it's worth $600,000, am I properly insuring my home? Did I leave it at $300,000 or am I now raising it to $600,000? Because the replacement cost is 6. Lumber went up, labor, good luck getting labor, a year wait for roofing supplies, demand, no supply. These are all problems. This is going to cause price increases. It's going to raise the levels. Insurance company gives you a check for $200,000 and you need $600 to rebuild. What are you going to do? You're underinsured. So these are the reasons why this is a good time of year. After you have your eggnog and unwrap your presents and throw out the Christmas tree and whatever you're doing, post New Year's, you want to make sure you go through your checklist, have a checklist, go through these things. And as we said, you want to rebalance your portfolio, you want to review your insurances, your auto, your home, your life. Health insurance probably already taken care of by the time the New Year's rolled around. But if we can help in any regard, I'll jump on that since you did. If we can help in any regard, always feel free to give us a call at 844-PLAN-MAN. Come to asktheplanman.com, planman.tv for our YouTube. We got a lot of other episodes out there. So anything else before we bring it home, Al?
Now, the last thing I was going to say is we've got a quiz coming out that's going to help you identify your financial gaps as well as your insurance gaps. By time this episode drops, that quiz will probably be available.
Come check us out. However we can help, folks. Again, this is another episode of Ask the Planman. I'm your host, Bruce Weinstein. If you fail to plan, you're planning to fail. Take charge of your life. Move forward. Do something. Be proactive. Until next time, thanks for joining us.